Welcome to Doug Fabian's Post-Election Investor Analysis, presented by Fabian Wealth Strategies, a fee-only investment advisory firm specializing in exchange-traded funds. Doug Fabian is the president of Fabian Wealth Strategies, with a career in financial services spanning over 35 years. The information contained in this presentation is for educational purposes only and is not intended as personal investment advice.
Hello, I'm Doug Fabian. Welcome to my presentation, Post-Election Investor Analysis. My subhead for this presentation, How to Prosper in the Age of Uncertainty. And I want to begin by laying out the goals that I have for today's presentation and what your take-home is going to be. Number one, I want to provide you with my analysis of the recent election and the new environment that we are entering into for investors. I want to give you a big picture view, a long-term analysis, the next 2 years, the next 5 years, the next 10 years, when it comes to your personal financial assets. I want to share with you today the current facts regarding our economic situation, the environment that we stand in right now, and I want to address the issue of whether or not the election has changed that. And then lastly, I want to provide you with an action plan that will help you and your family improve your situation as we move forward in time. Now, I hope you'll all agree with me that we are living in the age of uncertainty. There are positive things that are happening in the world environment around us and in the investing environment, and then there's a lot of things that we're concerned about. Let me talk for a moment about my audience for today's presentation, the people who are going to be listening to this broadcast. Number one, I'm sending this broadcast to all of my clients of Fabian Wealth Strategies, our asset management company. Number two, I know many of the subscribers to my newsletter, Successful ETF Investing, will be listening to this presentation. Also, the people who are regular listeners to my podcast, my weekly radio podcasts, I call this group my Inner Circle, are being sent a link to this presentation. And then I know that other people will pick it up, concerned investors out there who want to get somebody's opinion on what they should be considering for their finances in this post-election environment. I mean, we had an absolutely historic election, and there's got to be some adjustments that you would make to your investing portfolio or your investing strategy moving forward. Now, this is a very diverse group of people all over the country, and I even have clients in other countries who are U.S. citizens, and we're helping with their assets. But for most of the people I work with, for my clients, for my subscribers, they have some common traits, and I want to talk about those for a moment because I think that if you're listening to this presentation, you'll probably feel that you fit into this group. Number one, people that I'm associated with my money management business and who subscribe to my newsletters are successful people. They have led successful lives. They've had successful careers. They have saved money. They've accumulated assets. They have created income streams for themselves, not only while they were working, but also in retirement. Most people have manageable expenses. And then there is this common goal that people have. And it's not that they want to be ridiculously rich. It's that they want financial security. They want stability, and that they don't want to become a burden on their family members. And then lastly, I'll say that many people, and this was borne out, of course, in the exit polls from the election, that many people are concerned today. They're concerned about the direction of the country. They're concerned about the economic climate they're in. They're concerned about government intrusion in our lives, and that takes the form of taxation, regulation, and rules. They are concerned about the decisions of the political class. They're concerned about the lack of common sense. And I think many people view the current economic environment, even though the stock market in November of 2014 is at all-time highs, they're concerned about instability and volatility in the financial markets going forward in time. Now, we just had a historic election, but we can't just look at this one election. We actually have to back up. Let's go back to 2008. And in 2008, we had a historic election then. We elected President Obama, and the Democrats, after the 2008 election, controlled both houses of Congress. In 2010, that changed slightly. And, of course, the president was still in control of the White House, the Democrats still in control of the Senate. But the Republicans did gain a majority in the House of Representatives. In 2012, of course, the president won. The Senate was still controlled by Democrats, and the House got a little stronger in its majority. And then here we are, 2014. The president, of course, still controls the White House, but now the control of the Senate and the House is in the hands of Republicans. So the big question that is on so many people's minds is, what does this mean? Now what? Are we better off or are we worse off? And this second slide I want to share with you today is entitled, The Elections Have Changed Nothing. And I'm going to share with you now why I believe that even though we've had a historic election, relative to your finances and your financial future, so far, nothing has changed. Now, there could be changes in the future, and we're all hopeful that there's going to be more agreement in Congress and more things are going to get done that are positive for our economy and the future of our country. But I remain a skeptic at this particular point in time, and that's what the next few minutes of my presentation are all about, is sharing with you the facts of this period of time that we are in and how these facts are going to affect your finances going forward. You see, there are a number of things that are going on in the financial markets that have nothing to do with the election, really. But one of the things that has happened is politicians, not only politicians in this country, but politicians around the world, have shifted much of the economic direction of our countries to central banks, technocrats, people who are not elected, academics, and they have given those individuals tremendous power over the financial markets, and the central banks of the world have wielded tremendous power. And this slide that I have for you now, entitled Central Banks Continue Experimental Monetary Policy, shows you that over the past 8 years, there has been this tremendous expansion of the balance sheet of the central bank for the United States, the Federal Reserve. And what does that mean? It means that the Federal Reserve has purchased a lot of assets that they are now holding in their portfolio. I've heard one description that describes the Federal Reserve as the largest hedge fund in the world. It is holding more assets than any financial institution in the world. And, of course, that's at $4.4 trillion. Now, we understand the assets that the Federal Reserve purchased in 2008 and 9 in order to be able to stabilize the financial system in the depths of the crisis. And the Federal Reserve really prevented a lot of companies from going bankrupt by buying up debt, bonds. Now, what money did they use to buy up these debt and bonds? They really didn't use any money. They created credit that they extended. They swapped credit for assets. Some people call it money printing. But that's what they've done in order to be able to, bring stability into the financial markets. Now, once we got through the crisis and once we were in the 2010 timeframe, the Federal Reserve went one step further, and it started implementing different quantitative easing programs in order to be able to control the interest rate environment. And that's one of the most important things that you have to recognize. You understand that, for the last 30 years prior to 2008, money market funds paid 3%, 5%, 6%. Of course, we can go back to 1981, and money market funds paid 18%. But now money market funds pay zero. And why do they pay zero? Well, because the Federal Reserve has pushed interest rates down so low. And then the Federal Reserve, over the past 3 or 4 years, has bought bonds in the marketplace to continue to hold interest rates at a very low level and allow financial institutions to heal themselves and the economy to stabilize. With money market funds paying 0%, and bonds paying less than 3%, people have moved a tremendous amount of their financial net worth into the stock market. So the Federal Reserve has been there to kind of fuel a big run in stocks. And this has not only happened in the United States, but it has happened in other countries around the world. Certainly in Europe, there has been a lot of bond buying by the European Central Bank in order to stabilize bond prices, particularly in the peripheral countries like Greece and Italy and Spain that were having such problems in their financial markets. But there's been this huge experiment that central banks can create credit to buy assets to artificially hold down interest rates. And as we have gone through this election now, none of that has changed. Now, one of the things that has happened is the quantitative easing program in the United States has come to a close, and the United States economy is having some of the best quarters it has had in terms of economic growth in the last 5 or 6 years. We're currently on pace to have economic growth in the fourth quarter of 2014 of around 3%. So that's been the best growth rate we've had in quite some time. The average growth rate of the last 4 years has been less than 2%. So we're starting to gain some stability, and the Fed is kind of backed off. But moving to my next slide, the Bank of Japan has now embarked on the largest quantitative easing program in the history of mankind, and it is now expanding its balance sheet quite rapidly. And one of the things that's happening in Japan that's pretty shocking and unusual is that the credit that they're creating, they're starting to run out of bonds to purchase from Japanese securities, and they're starting to purchase stocks. So the central bank in Japan is purchasing equities and purchasing ETFs and purchasing REITs, and they are also, the politicians in Japan are now authorizing the pension funds in Japan to have a higher exposure to the equity markets. The whole idea here is to try to lift the value of the stock markets. And, of course, this was done here in the United States. Right now, we'll say it was done successfully. And so Japan is trying to do something similar and bring economic prosperity by inflating a stock market that has been in the doldrums for 25 years. At the same time, though, something else is happening that is quite extraordinary in Japan. And what is happening is the Japanese currency, the yen, is absolutely collapsing. Since Japan has embarked on this more aggressive quantitative easing program, the Japanese yen has fallen by 1/3. 1/3 of its value has been lost. So if you are a Japanese citizen, retired, and had most of your money in a savings account, now your cost of living has gone up significantly because basic things like utilities and energy and food have all gone up in cost. And so you've had a huge inflation in your life. Now, if you've got some exposure to the stock market, the Japanese stock market is up some 40% in the past 18 months, then that's been a good thing. But if you haven't had exposure to the stock market, you have not benefited. My closing point regarding the current state of the world is that the financial institutions, the central banks, the Federal Reserve, the Bank of Japan, the European Central Bank, are all still very involved in our financial markets, holding interest rates at zero, manipulating the real price of bonds, potentially artificially inflating the stocks, and are creating the foundation, if you will, for the next financial crisis. So the first thing that hasn't changed is central banks being involved in the financial markets, and I'm going to talk more about how that's going to affect your portfolios longer term. Second, let's talk about the election and the federal budget deficit. You can see from this chart that the budget deficit, and this is the budget deficit charted as a percentage of our gross domestic product. Look at 2009, in the height of the financial crisis, when tax revenues and the economy, shrunk. Deficit spending, in order to be able to provide all of the services that we provide to our citizens, as well as provide the Treasury Department for the TARP program, there was this huge expansion of spending here in the United States, and it added to the deficit significantly. But we had a deficit as a percentage of our GDP at 10%. Since then, it's come down. But as you can see, the historical average over the past some 50 years has been about 2.2%. And we're currently in the 3% range with our deficit. Deficit is definitely down, and economic growth of late is helping this situation. But I want to point out, and these are numbers from the Congressional Budget Office and the Office of Budget Management. These numbers start to turn very bad again in the not-too-distant future. So the election has changed nothing relative to budget deficits. And I don't think that that's going to change. The Republicans may want to change that, but they don't have a supermajority. They can't override a presidential veto. There's still a lot of Democrats in Congress who believe that deficit spending is the way to provide services to people that need it. And so we still are trapped in a deficit spending world. Now, let me move to this next slide. Debt continues to expand, exceeding 2008 crisis levels. You can see that looking at the presidencies of the last 7 presidents. Everybody loves deficit spending. And, we had a $2 trillion deficit under the 8 years of President Clinton. We had $5.4 trillion in deficit spending under President Bush 43. And then President Obama's projected budget deficit is going to be $7.2 trillion. So politicians love the deficits. And the reason why they love the deficits is because they're able to hand out the goodies, make the promises to people, and they are expecting future generations to deal with this. So the debt, again, central banks, problem number 1. The deficit, problem number 2. The continued accumulation of debt, in my mind, is problem number 3 for us. And I'm going to get to how this is going to be a problem for you, the people who have run your lives successfully, as a main part of my presentation here. And then, of course, we have global debt. And I know that there's a lot going on this chart, but I want to point out the left-hand side yellow mountain chart. You can see that global debt today is significantly above levels that we were at in 2008. And we now have $100 trillion. Many times you talk about how much debt the United States has accumulated, but you don't think about the rest of the world. Well, certainly the country of Japan is much worse than the United States, but also collectively the continent of Europe is adding to the debt loads. But every country in the world is carrying some sort of debt. But what's happened in the last 7 or 8 years is countries have tried to use this scheme of creating debt to create economic growth. And it has barely moved the needle. And right now, the country of Japan, third largest economy in the world, is sitting in a stagnant situation, unable to generate growth past 1%. Europe is on the threshold of a recession. And the United States is the, one developed country in the world that's, doing okay right now. But, we're one financial crisis away from another recession. I'm not predicting that we're going to have a recession on a short-term basis, but I wanted to give you this big picture analysis because it is going to drive, and it should be driving, investment decisions and planning decisions going forward. The next chart I have for you is something that doesn't get talked about enough, and I think everybody's aware of it, and that is the fourth problem that we face. And the problem is, of course, demographics. And we have an aging population here in the United States. We'll call it 2015 right now. There are 41 million Americans who are age 65 or older. In 2030, 15 years from now, not too far, I think most people listening to my broadcast are probably going to be alive in 2030. But 15 years from now, we're going to have a 40% increase in the number of people who are over age 65. And that's going to go to 72 million people. Now, I bring this up because when people are over age 65, they are collecting Social Security, they are collecting Medicare, and they are now not contributing as much as they were in taxes, and they're taking much more in terms of benefits. And this is one of the reasons why we're continuing to see this projected expansion of budget deficits going forward. The longevity in the United States continues to rise. Here, 1975, longevity was around 72. Here in 2010, this chart goes up to longevity 78. Many times people ask me, Doug, how's your dad doing? My dad is doing fantastic. He is in very good health, and next year, 2015, he's going to be celebrating his 90th birthday. My mother-in-law is 96 years of age. I have several clients who are in their 90s. So, people are living a lot longer. And so we have to realize that if you're age 65 today, you could easily live to be age 90. And therefore, you're going to need to make sure that your nest egg lasts 25 years or longer. And so you got to do the proper planning to make sure that that's going to be the case. Now, one other issue regarding the subject of entitlements and demographics and Social Security. Many people are not aware of this, but you can see from this chart why it matters. Social Security deficits are a permanent and are set to quadruple in less than 20 years. But in 2008, Social Security was still running at a surplus. On an annual basis, there were more dollars coming into Social Security than were being paid out. In 2010, that changed. Here in 2014, it's about $75 billion. We get out to 2020, it gets to $100 billion a year. And this is another reason why the country's cash flow gets all out of whack. And so this is something that we have to understand as we're moving forward in time. Now, the key question is, how will the tax revenue support these trends in entitlement and the fact that we also have a growing debt each and every year, and the interest on the debt continues to go up. And you can see that more and more of our budget annually is being taken up by Medicare, Social Security, of course, other programs like Obamacare and the SNAP program, other welfare services, and then, of course, you've got net interest on the debt. So we've got some issues that we have to understand, and there's not a lot you and I can do about these issues. But we have to understand that there are some problems that we face that we need to address. So let me just talk about some conclusions from these facts that I have laid out in front of you. And the conclusions are this. Central banks are still very involved with all of our financial markets. the interest rate markets, the stock markets. We have this zero interest rate policy. There's this perception that central banks are backstopping any risk. They're providing a lot of confidence. And now the central bank in the United States has kind of handed off the quantitative easing to the central bank of Japan. That's going to help the global economy. That's the whole idea. I wouldn't be surprised that the European Central Bank gets involved with some sort of quantitative easing program at some point in time. But in my opinion, the house of cards continues to grow, and it is the seeds of the next financial crisis. Second, deficit spending is here to stay. The Republicans don't have the votes to override vetoes. And also, Americans are very dependent upon deficit spending, the government services, so they really don't want to change. And then, of course, the debt continues to grow, and our demographic situation does not get any better. So the next slide I have put up on the screen, headwinds ahead of us, are these three big issues. Number one, and at the top of the list, is the next looming financial crisis. And I came across something in my reading today that the U.S. stock market is the most expensive stock market in the world with a P/E ratio of 19. So certainly, if the economy grows and earnings continue to expand, there's nothing wrong with that at this particular point in time. Stock market is not as overvalued as it was in 1999, but the stock market has had a tremendous run and the economy is now starting to catch up. But we have to realize if anything comes along to, kind of upset the trends, that is going to be problematic from the standpoint of where stocks stand today. Number two, we are going to be faced with higher taxes. And I'm going to talk more about taxes throughout this presentation. But this idea, this myth that taxes go down in retirement is just that. I have seen the fact that as I help clients with taxes, as I work with CPAs around the country, I'm continuing to see clients get hit with higher fees, higher taxes, and it's not this fairy land idea that taxes go down once you retire. And then lastly, at some point in time, there's going to be some sort of entitlement reform. I don't think this problem changes in the next couple of years. I think the entitlement reform is out in the future. Maybe it's going to be the next president's problem to deal with. And I also don't think that they're going to cut entitlements. What I think they're going to do is tax entitlements to a much greater degree, especially for people like yourselves, people who have done things correctly. A statistic that was just so surprising to me is the fact that, and let me get these numbers correct here, 36% of Americans have no savings whatsoever, and more than 50%, matter of fact, the number is 57% of Americans have less than $25,000 saved for retirement. So you have to realize that the majority of the people in this country don't have a retirement savings plan. And therefore, what politicians do is they go after people who do have retirement savings plan and make their lives much more difficult through taxation, through regulation, through rules, in order to be able to get their hands on that money and spread it out. So higher taxes, entitlement reform, the next looming financial crisis. How are we going to deal with these things? That's the subject of the balance of my presentation today. So let me talk about some investor mistakes, common investor mistakes. And where I have gotten these mistakes is from real-life experiences. Here at Fabian Wealth Strategies, a service that we provide to clients and prospective clients is that we do retirement income plans, very detailed discussions with individuals and families about their current financial situation. And I've done over 50 of these plans. My firm and my team and I have done over 50 of these plans in the last 90 days. And here is what I have uncovered in this planning process and the mistakes that I see over and over again. Number one, there is an underestimation of living expenses, tax burdens, healthcare costs, and inflation. Now, people seem to kind of gloss over the real cost of living, especially going forward. Number two, there is an overestimation of income and an overestimation of the returns on their portfolios. So the overestimation of income comes into play, that people have a tendency to think that if they're getting $2,500 a month in Social Security, that whole $2,500 a month is applied against their expenses. And it's not true, because you have taxes to pay in many cases on that Social Security income. And so people don't look at their income on a net basis. They look at on a gross basis. And then, of course, next item is they're taking too little risk, meaning that, I've seen $1 million portfolios with 90% of their allocation in money markets, meaning they're getting a negative rate of return. So people are taking too little risk, or the other side of the coin is they're taking too much risk. And, taking a lot of risk in a rising market is no problem, but taking a lot of risk and having a financial crisis come along can really ruin your retirement. And that's the last point I want to make. People are unprepared. And since it's been so long since we had the last financial crisis, there's a tendency to feel like the sky is clear, the seas are calm, the wind is blowing in a good direction, and everything looks great. Well, that's when financial crises have a tendency to rear their ugly heads. So these mistakes are mistakes that I want all of you to avoid. Now, looking at the next slide here, what should you do? What should you do right now? And so many times people want to know, what's the next thing I should buy for my portfolio? And I have to tell you that, where you might allocate, 1%, 5%, 10% of your portfolio is not going to matter if you get these other things wrong. If you don't do some more detailed planning, you're going to find yourself in very bad shape at some point in time, and then you'll be in a crisis situation. So I want to avoid the crisis situation, and the way you do that is the thing you should do right now is you need to do some deeper planning. This next slide, plan, and plan again. Warren Buffett quote, "Someone sitting in the shade today because someone planted a tree a long time ago." A great quote. All great achievements come from having a good plan. And if you were a business owner, you had a good plan. If you started saving money at a young age, you had a plan. But one of the things that I've found in my conversations with families is there's not enough planning going on in your retirement or as you're approaching retirement. So if you want to have success, great success, your success is going to require having a comprehensive financial plan. Now, what does that include? It includes a plan for taxes, a plan for your estate, a plan for retirement, and investment strategies or investment plans. And once you have those four components, you can execute, and of course, you can evaluate those plans over time. This next slide, of course, gives you the elements of a successful plan. And boy, if there's an area that I think that is lacking more than anything else, it is the area of tax planning. People are giving some thought to retirement planning, but tax planning, people just seem to kind of wait until it's time to do their taxes. And if you're doing your taxes in March, preparing everything for your tax preparer, for your CPA in the month of March for the previous calendar year, you can't do any tax planning. Tax planning requires thinking about the next couple of years relative to taxes, understanding that the rules are changing. The tax rules change every year. The Obamacare rules are starting to kick in and hit more people with taxes that they didn't expect. So tax planning is going to be very key, because with tax planning, you can start to make some different investment decisions. Sidebar, one of the things that we've done with some of our higher income earning clients is we have moved a much greater percentage of their portfolio into tax-free investments, because it just makes so much more sense. It's a way to be able to lower their taxes and still have a decent income stream. The second element of a successful plan is retirement planning. And retirement planning is not about just generating a budget for a single year, but it's about looking at the next 5 years, the next 10 years, the next 20 years. Estate planning. Estate planning, of course, begins with having an estate plan itself, having a living trust. I believe almost all of you who are listening to this broadcast should have a living trust. Of course, living trusts are created by attorneys in the states that you live in, but are very important documents, not very expensive, but documents that need to be updated from time to time. And it's something that I would say needs to be on your financial bucket list. You've got to get this done. The investment planning, of course, is key. And then lastly, I believe that as people, and especially people of means, people of wealth, people who have a net worth in excess of $1 million, you should have a team of financial professionals that you're working with. That is a CPA, an estate planning attorney, and an investment advisory firm or individual who has the experience to be able to bring you ideas and action steps that you can work with. Now, I want to point out here that hope is the strategy most people are using today. Investors are planning as they go. According to a recent survey of baby boomers by the American Association of Retired Persons, 40% plan to work until they drop. Your future success and the longevity, more important, the longevity. Remember, your retirement plans have to last maybe 30 years, or certainly 30 years to cover your family, your spouse. So the development of those plans, boy, you don't want to have a plan failure in your 80s. People have a tendency to take action when the pain becomes unbearable. And the best example of this is the redemptions from the stock market and in the last 90 days of the financial crisis were unbelievable. And that, of course, is what makes a stock market low when everyone decides to panic and sell. But you certainly don't want to put yourself in that situation where you're selling after a 30 or 40% decline. But that's what most people did. Your plan must include projections, short-term, intermediate-term, long-term, these kinds of items. Now, let me discuss with you for a few minutes action steps, and then I want to talk a little bit about the financial markets. But action steps, and again, the cost of what I'm going to discuss with you today is quite minimal. Tax planning, 1 to 2 hours of your CPA's time, could be as much as $500. I think a reasonable amount of money to have your tax professional spend some time with you looking at the next couple of years. And again, one of the things that you can do with tax projections is start to do some tax planning. One of the things that I'm doing with some of our clients is moving them more towards the tax-free income, as I mentioned. Another strategy that we are implementing for some clients is a conversion of an IRA to a Roth IRA. Looking at, harvesting tax gains. Many people have tax losses left over from the financial crisis that they can be using against current gains in their portfolios. So there's a number of things that you can do when you're doing tax planning. But if you're doing no tax planning, then all you're doing is meeting with your CPA, finding out what the pain is, what's my taxes going to cost me this year, and then you're writing the check. But those numbers continue to go up. And if you really want to manage taxes, you've got to get involved in tax planning. Second, and again, I'd put this at the top of the list for many people, if you don't have a living will, trust, estate plan, very inexpensive, $1,500 to $2,000. If you have a more complicated estate, multi-million-dollar estate, it can run more than that. But things are pretty boilerplate today, And what you're doing here in setting up wills and trusts is to be able to, avoid probate and in some cases be able to control financial assets after you're gone. I just work with a client on setting up an IRA trust for some of their children that don't have the financial skills to be able to handle large sums of money. So with an IRA trust, even when you're not here, you can kind of govern the amount of income that people are receiving and control things. In some cases, that needs to be done. So there's a lot of things that an estate plan brings up and that can help you achieve your legacy. And I know most people's legacy is they want to provide for their families. They want to be able to help the next generation. They want to provide financial education resources for grandchildren. They want to be philanthropic. Whatever your goals are, great. But without the proper planning, then you're winging it and your wishes are not going to be implemented. Number 3 on the action step list is to create a retirement plan. Here at Fabian Wealth Strategies, we are provided with some very good tools by Fidelity Investments to create retirement income plans for our clients and people who might be considering being a client. But this is a service that we offer that will take into account your assets, your income streams, your expenses, your taxes, and inflation, different rates of return on your portfolio, and look at whether or not 5 years, 10 years, 15 years, 20 years, 30 years from now, you have a problem or don't have a problem. And also it allows you to be able to see what your portfolio might look like when you're closer to your end of life, and that helps you set up what your legacy plans will be. So there's a lot of really good things that come out of retirement planning. And best of all, you're getting some really good information and you're going through the details. This is like business planning for your retirement. And if you were going to start a business and you were going to sit down with a son or a daughter and coach them on starting a business, a grandchild to start a business, you'd be encouraging them to show you their business plan. That's what retirement planning is about. And then lastly, investment strategy. And I want you to think about your investment portfolio right now. And some of you are enjoying gains from the stock market or individual positions, good income streams. Others who are listening to this presentation are not participating. You have very high cash positions in your portfolio because you have concerns about the political landscape or the economic landscape, but you have to realize that getting a 0 rate of return is actually the equivalent of getting almost like a minus 1.5% rate of return, because there is inflation out there, and you're not going to be able to live 20 or 30 years in retirement by getting no rate of return on your investments unless you have accumulated significant assets. So, ladies and gentlemen, I really believe that having a detailed planning process, now that we're in the post-election environment, now that as we are approaching calendar year 2015, we don't know what's going to come out of Congress. One day it looks like the president and the new leadership want to work together. The next day it looks like they don't. There's liable to be more volatility ahead if the Congress and the White House come to, impasse on subjects like immigration or subject like job creation that can create problems and uncertainty, and financial markets don't like that. There are many things that could touch off the next financial crisis right now. We have, Europe and Japan both on the verge of recessions. We have a looming terrorist problems. We have, the issues that are developing with Russia. So you've really got to be aware of these problems, and your investment strategy needs to take these problems into account. So one of the things that we are doing here at Fabian Wealth Strategies is we can offer to you an investment analysis and a retirement income plan if you have assets in excess of $500,000 and you would like our help and are agreeing with the things that we're talking about here and want to get into some more detailed planning, then we would offer our services to help you. at no cost or obligation, as we're going through a process of considering, working with us as your investment advisor. So take that into consideration. Now, let me talk for a couple of minutes about the financial markets. And let me begin with U.S. stocks. And this will give you some idea of how we view markets right now. The U.S. equity markets continue to be the most expensive financial markets in the world. And a lot of money has flowed into the U.S. because of the strong U.S. dollar. People feel like the central bank here in the United States has created a stable economic situation, but U.S. stocks are not cheap and they are vulnerable, so you've got to pick your places quite gingerly. Second, the Chinese stock market is one of the cheapest stock markets in the world. And one of the things that we're doing right now is allocating a greater percentage of our investment portfolios over to the Asia region because Europe's not working. Japan, of course, is a big question mark right now. Latin America, because of its dependence on commodities, is just really reeling. But Asia is looking good right now. And having more international exposure in your investment portfolio, we think, is a good thing going into 2015. Now, the cyclical trends favor stocks in 2015. The third year of a president's term is almost always positive for stocks. And there's reason to believe if Congress and the White House are able to work together for better economic policies, that we could see strong growth in the U.S. economy in 2015. But we have to be prepared to manage downside risk. And that's one of the things that our firm specializes in doing. Second, interest rates. I can't tell you how many conversations I've had with people who think that interest rates are on the verge of going through the roof. And in my opinion, interest rates are going to remain stable going forward. We're currently sitting at an interest rate, 10-year Treasury bond, 2.4%. In Germany, interest rates are at 0.8%. And in Japan, they are at 0.4% for the same security. A 10-year bond in Japan, a 10-year bond in Germany, significantly less than the U.S. We are expecting that interest rates are going to remain stable. Can they go to 2.6%? Sure they can. But 3% or higher, I don't think so. And this means that the low-rate environment, higher-yielding securities, closed-end funds, REITs, MLPs, alternative income strategies, opportunities to be able to get returns, yields of 6% or more are quite good right now. Now, in regards to currencies, today the U.S. dollar is sitting at its highest level in a number of years, and the euro and the yen are in downtrends. One of the things that I'm watching for is a currency crisis. If we saw a real collapse in the value of the yen, it could be disruptive to the global economy because it could set off a series of trade wars and competing currency devaluations that create instability. This is a concern. And then lastly, oil prices. Oil prices and commodities continue to kind of signal a deflationary environment. And deflation, of course, is a contraction in the global economy, and that is not a good thing. So I hope that oil prices and commodity prices stabilize and we see economic growth and things get better. But that's something that we're having to watch quite closely. So I wanted to give you that overview of my opinions right now on the financial markets, but I believe that the next best step for you is to get your financial plans together. Taxes, estate, retirement, and investments. And I want you to know here at Fabian Wealth Strategies, we are here to help. If you would like to discuss your goals and objectives in more detail, please give us a call. If we're going to do some retirement planning for you and investment strategy discussion for you, we will do so for those of you who have investment portfolios in excess of $500,000, and we will do our best to show you the value that we can bring to your portfolio at no cost to you, and you may decide to hire us at some point in time, but that'll be a decision that you'll be able to determine. So I hope you have enjoyed this presentation, and I wish you the best. And there'll be more to come from us as we're closing out 2015. This is Doug Fabian. Thanks so much for joining me today.
Thank you for watching Doug Fabian's post-election analysis, How to Prosper in the Age of Uncertainty. For assistance with your retirement income plan and a comprehensive portfolio review, call 800-391-1118 or email info@fabianwealth.com.